Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordeurn. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the programme, sir. I was hoping for a quiet weekend. We're not getting one going into this opening bell. We've got a threat against Europe, a threat against Apple. Out of the two of those, what do you think is more important to this market this morning, Jim?
Oh, I think it's probably Europe because it's a bigger market and encompasses more goods. So we're back to tariffs on. And tariff on, I think, is going to be an interesting way for the market to try and navigate this. Does that mean that we're going to see weakness because we're going to have higher prices? Or is it because we're going to have higher prices? Which one is going to be the dominant factor? Now, when we turn it to the Federal Reserve, they usually are focused, I think, more on prices. And I think that's the thing that a lot of people on Wall Street are missing, is that all things being equal, if tariffs are coming back and prices are going up, and that might be weakness, the Fed's not going to cut rates. They're not going to cut rates until they see that prices have stabilized. And right now we might be looking at more inflation.
So, Jim, that take's important because I want to take you over to the move of the bond market off the back of this news. Yields are lower across the curve. We're down 8 basis points at the front end, 391. I know we're not breaking out of the new range, the range of the last several months, but still, yields are falling back. The 10 years down by 6 basis points, 447. What would your response to be to that early move, given that you think this ends up with more inflation down the road?
Well, that's a knee-jerk response to the stock market falling. I think what we're seeing right now on this move. But if you were to back up and go back to, when we started talking about tariffs, there's been a trend higher in yields. And the trend higher in yields is really about, as things settle down, we're looking at higher prices. As I'd like to argue, if you look at the tariffs that were collected in April, that was 1.75% increase on the $400 billion of goods. That's an extra $7.5 billion of tariffs in April, 1.75% on the $400 billion of goods that we imported in April. Who's paying that? Somebody's got to be paying that. Now, the president wants us to believe it's going to be Walmart and Apple eating those tariffs and maybe the Chinese. But if you look at numbers like Trueflation and price stats and stuff, which are these millions of prices that they check on the internet, prices are going up. The prices are going up for the consumer. And I think as that continues to happen, that reality is going to drive the bond market more than a weakness reality.
One thing that we've been talking about throughout the morning, Jim, is that this is not isolated to the United States when it comes to the yield move and some of these inflation concerns. How much is this applicable in terms of a broader inflation globally in developed markets that leads bonds globally to be less attractive in the same kind of way as they were traditionally for a price action, albeit more attractive from a yield perspective?
Oh, I think you're right. It does affect all bonds worldwide, especially developed markets, because the tariffs are pushing all these markets to do trade deals. The UK and the EU have done a trade deal as well. And so what we're seeing is the opposite of globalization, which I've become aware is now the word is segmentation. So we've got a segmentation coming in global trade, and that's going to just add frictions and add more costs. And those costs are going to show up as elevated or sticky inflation, and that's going to start to impact all bond markets. And it has been, because if you look over the last month or so, developed world bond markets have been going higher. The one exception has been China, where their interest rates have been moving lower. But their economy is in such an alarming shape right now that you could almost argue that even with these higher inflationary numbers that we have, their economy is more being driven by growth than it is being driven by prices.
I'm struck by the fact that the bond yield move is not special to the United States. It is something that is global in developed markets. The move, though, in the dollar is distinct, and it is raising a lot of concern that this could be the biggest casualty of some of the trade disagreements. We are seeing a bit of a strengthening in the dollar off the heels of this news with respect to potentially higher tariffs on Europe. I just wonder whether you think that this weaker dollar theme is going to persist, even if you do get some serious, significant increases to to tariffs on some of the trading partners in the U.S. At a time when a lot of people have shrugged off some of what these proposals could do?
Well, yeah, I do. I do think that the weaker dollar will persist for a couple of reasons. One, I think it's what the administration wants. It doesn't, or at least it's not going to complain about a weaker dollar. And the weaker dollar isn't really bringing around talk about the end of dollar dominance or the reserve currency. It shouldn't, because there isn't an alternative to it. So they want it. And the second thing is, if you've watched the currency markets long enough, you'll realize that when these things trend, they trend much further and much longer than everybody thinks. Whenever you think the dollar is overbought or oversold, the joke is, wait till you see how overbought or oversold it's about to get. And right now, it is trending lower. And I suspect that over the next several weeks or few months, that that's going to continue. Even if we get higher rates, even if we get a widening of spreads to, say, Europe or something like that, that hasn't been working right now.
Jim, I just want to finish on the equity call. The equity market, there is a playbook here. The president comes out and tries to anchor negotiations with extremes. Come out and say, you're going to face a 50% tariff on June 1. You've not been great to deal with. Does the same playbook that applied to China apply to Europe? Is this different? Have we exhausted that? Because there will be a lot of people out there thinking, okay, equity futures have gapped lower. I'm going to buy that. I've seen this movie before. Is this different?
I mean, it could be. I mean, the biggest issue I think that Wall Street's been struggling with is, are tariffs leverage to get a deal, or are tariffs revenue? If they're leverage, I think most people on Wall Street would be fine with that. To get a deal, to use them as leverage to lower tariffs, open up trade. But are they a form of a tax on foreigners to try and raise revenue? That has been the bigger issue that we've been trying to struggle with. When it comes to Europe, I think most people think it's more in the leverage camp, and therefore this is just a negotiating ploy. When it comes to China, I think more people are worried that it's in the revenue camp, and it's more than just a leverage play. So that's why I think that when it comes to Europe, it's going to probably be viewed as a leverage play to trying to get a deal done sooner rather than later.
Jim, appreciate your time, sir. As always, it's good to see you. Jim Bianco there of Bianco Research. Nadia Lovell of UBS downgrading US equities to neutral, writing, we see limited upside near term and expect continued volatility as trade and US fiscal uncertainty remain high. Nadia joins us now for more. Nadia, good morning.
Good morning.
How good does it feel not to defend an overweight going into the weekend?
It never feels good when markets are down, but, this is some of the issues that we were struggling with last week, and we were concerned about. As Lisa said, we were past peak uncertainty, but there was still uncertainty, still remain high, and that's why we downgraded U.S. equities last week. Now, we had been attractive view on U.S. equities in April. We took that opportunity right after the 90-day pause. But after being up 13% in a month, we just thought that the risk reward was balanced. And yes, the effective tariff rate has come down from 25% to 15%, but it feels like a lot of the good news was already priced in. And there's risk for it to go higher than the 15% it is currently, obviously.
Price action, as you know, can condition behavior. I just wonder how many investors have been conditioned by the experience of April. Big dislocation, then things soften and markets rip. And you can miss out really quickly. And we saw that early this week. We had this small dip off the back of a downgrade, dip gets bought. And I just wonder from your perspective whether this dip is going to be bought too, because people have got the playbook from April. Maybe they're comfortable with it. We know that the president likes to anchor negotiations to the extreme, comes out and says to Europe, make a move, otherwise you're going to get a 50% tariff, equity markets pulls back. Would you suggest people be more careful this time around, or do the same rules still apply?
Yeah, we are looking for opportunities to buy dip. 1%, 2% down is not much of a dip for us. If we see a 5% down, that's a different conversation. At the same time, we also have equity valuations that have recovered. We're at 21 times forward PE, above the 5-year average. So there's very little room here. And at the end of the day, we know that it's earnings over the longer term that would drive markets. And we think that the consensus earnings is still too high. 9% from consensus this year. We think it needs to come down closer to 4%. 25%. So we're also waiting for just more clarity around what the tariff policies will eventually look like. We thought that 90-day pause will take us to July. Obviously, now it's, potentially June 1st. And remember, we still have the sectorial tariffs to come on the 5 critical sectors, pharma, semis, lumber, copper, and critical minerals. And we're not sure what those exactly are going to look like. Is it 25% or is it something higher?
I'm looking at your base case. It's 6,000 in terms of year end for the S&P 500. The bull case is 6,700. The bear case is 4,500. What could get you to feel like one or the other is the more likely tail risk?
It depends on what happens, after this 90-day pause or something even shorter than that, obviously. Now, if we see, a re-escalation and those reciprocal tariffs get put on or even at a higher rate, that is going to have a huge drag on the economy, and that puts us closer to a recessionary scenario that would get us to that 4,500. What could get us up to that 6,700? Right now, there are legal challenges. We know, you have Oregon versus Trump. You have, VOS versus Trump. And there could be a decision in the next couple of weeks, potentially an injunction that will challenge, the use of IEEPA for these broad-based tariffs. And the market isn't priced for that. So you could see some of that, but that's not to say that that's going to be the end of the story, because there's always a Supreme Court, and that could be taken to the Supreme Court and be reversed. But that's what could get us to that 6,700 if we get any sort of rollback, even the baseline tariffs.
Who's trading every day? And I ask this because there are so many people who come out with these conspiracy theories. It's the retail trader on the margin that's creating the buy the dip mentality, and everybody else is just following them. It's the hedge funds that are causing the volatility in the bond market. I mean, is there truth to that? That there are these technical underpinnings that are just whipsawing everything, and that we're the ones here trying to make a narrative out of it?
There is a little bit of that. There's also systematics as well that are in the market, and when you see spike in volatilities, those funds have to also respond to that. So there's some of that. The retail investors have been in and out of the market. I think the retail investors right now is a little bit more hesitant to sort of buy the dip. And so that's at the end of the day, it's the flows that are driving the near-term volatility in the market. But I think that the real money is still trying to assess, what economic growth is going to look like in the second half. We think that you will see the economy slow close to a 1.5%. So again, not recessionary. But again, although the range of outcome have narrowed, it still can end up to be flat growth, or it could be 1.5%, dependent on trade policies and the president's tweets.
Nadia, just finally, just before you go, within that defensive posture you have relative to where you were before, what do you like in equities? What's the favored sector at the moment?
Look, we still continue to like tech. We've seen a rebound, but I would say tech, excluding Apple, is in a better place than it was back in February when it was at its high. Why? We've seen, the pause on the China-U.S. tariff. We've seen a rollback of the AI diffusion rule that was supposed to go into effect last week. And so we also see a pickup in CapEx spending. Look at all the deals that have been announced, around sovereigns, CapEx spending in AI. So we think that the outlook for tech has actually improved than it was just a few weeks ago.
Nadia, appreciate your time. You knew what the follow-up would be, didn't you? Apple. Telsey Advisory Group downgrading Decker's Outdoor to market perform, noting the company's lack of visibility around tariffs. Let's stick with retail. Dana Telsey weighing in on a mixed earnings season, writing a consistent narrative across retailers and brands is that higher costs will be passed on to consumers. Dana joins us now for more. Dana, good to see you. Good morning.
Nice to see you. Thank you for having me.
Are you seeing that across the industry? Are there any bright spots where they're able to withstand this shock?
You've seen some companies being able to withstand the shock, whether it's a Ralph Lauren and a Tapestry. Brand leaders are making the difference with product innovation, but most others, the impact of tariffs is uncertain in terms of the magnitude and also the acceptance of price increases by consumers. Because at the end of the day, retail is going to have to raise prices with these types of tariffs.
We were talking after Walmart released earnings and came out saying that because of tariffs, they might have to increase prices, and said maybe this gives actually a carte blanche to other companies to say, we too are getting affected by tariffs and are going to have to raise prices. Are you surprised we haven't seen that more, or that companies have been sort of chastened, in your view, by what happened subsequently with respect to a response from the president?
I think no company has the scale or the attention of the president like Walmart does. It's the biggest one out there. Most of the other companies are now saying what the impact of tariffs could be or the magnitude of what the cost will be. They're not saying what the price increase will be and how much it will be, but what they are saying is that the second half of the year, we don't know how our customer is going to react to price increases. For the most part, retailers are going to raise prices, not on every good, but on a select amount of goods. And that is drawing concern about a slowdown in terms of consumer spending in the back half, because will consumers pay or will they not pay?
Companies are spending so much time thinking about how to communicate. They're going into earnings season almost unbothered by what the numbers look like in the quarter and trying to work out how to communicate what the next quarter might look like the year ahead. Dual guidance, cut the guidance, pull the guidance, keep the guidance. Who has approached this in the optimal way from your standpoint? Who would you like to celebrate? Who do you think has done the better job this quarter?
Well, like I said, I mean, Ralph Lauren and Tapestry both have done a very good job, given they were able to talk about what's happening with their pricing now, what the consumer acceptance is. When you think who else? TJX has done a very good job also. Most companies are talking about how sales are here and now, not just the first quarter. Because to your point, it's almost like revenues and business in the first quarter is divorced from what's happening now. It's like you said, it's a week-by-week basis in terms of what's changing. More to come next week. Gap, Ulta. There's a lot more to come. Macy's in terms of what we'll see.
Consumers say they feel terrible. What are they doing?
I think consumers, for the most part, depending upon their income level, they're pulling back. They're more discerning on their spend. You're seeing it in terms of some of the data of travel and what they're not looking to do or how they're pulling back. Take a look at luxury brands. Luxury brands, except for those at the super high end, we've seen a slowdown in luxury brand spend too. So they are pulling back on their spending, also at restaurants.
You say depending on their income.
Mm-hmm.
What is the big difference right now between low-income and high-income earners and their spend? And I think what we've been tracking around this table now for years is that high-income spenders, consumers in this country, have held up well. We're trying to work out whether the stress is migrating up. You mentioned some pressure in luxury. Are you seeing signs of that?
Well, we've seen signs of pressure in luxury because of the slowdown in sales. Look at LVMH's sales, which were down low single digits. It's different than what you've seen from LVMH in the past. We've seen, for example, look at traffic to some of the different types of centers. We've seen that slow down. We've seen on grocery purchases more of an increase in some of the private label. So I've seen that change. I'll tell you, I was at a real estate conference earlier this week, and the mood is everything's good but. The but meaning that when is the greater slowdown going to occur, and the bulk of when price increases could start sometime during the early summer.
Anyone moving production back to the U.S.?
Very hard. Can't move production back to the U.S. Too costly to make. Who has some of the greatest production in the U.S.? Bath & Body Works. Around 80% of their goods are made in the U.S.
Did not know that.
Yes.
Dana, thank you.
Thank you.
Appreciate the stat. Dana Telsey, the Telsey Advisory Group. On the trade situation and what it all means for markets, I'm pleased to say that Russell Brownback of BlackRock is with us around the table. Russell, good morning.
Thanks for having me.
Give us the constructive view for the U.S. economy this morning.
Okay, so we have another dose of uncertainty this morning, but it's no different really from the last 3 years where we had a historic Fed tightening cycle. We had a regional banking crisis that felt scary in the moment. Last year we had a very acrimonious election, and you had these structural underpinnings in the U.S. economy where in both 2023 and 24, the economy accelerated into the fourth quarter. Now, listen, we've got some real sort of fundamental headwinds, some stagflationary kind of evolutions that at the margin will reduce growth and maybe tick inflation up a little bit. But it's far from a recession from our call. And again, underestimate these points of resiliency at your own risk.
Well, this is your point. It's really important. You believe that we are underestimating America's ability to absorb shocks. I just wonder how you're expressing that in financial markets at the moment. What are you doing?
Yep, so in our multi-sector fixed income portfolios, actually you probably heard Rick Reeder say, this is the golden age of fixed income. Actually, it's the golden age of income. And when you have a yield curve that's elevated and flatter than it's been historically, that front to the belly of the curve is this incredible opportunity. And then you can take what is really robust credit quality, put corporate credit, securitized assets together, and create a high-quality portfolio that yields 6.5% to 7%. And because of where you own your duration, you don't have all that volatility at the back end of the curve. So it's a super high Sharpe ratio portfolio.
Who is it income for? And I ask this at a time when a lot of people are wondering exactly who the buyer base is going to be for this fixed income, given some of the international aversion to U.S. assets.
Yep. So listen, I think the reality is we live in a world where there's too much money and not enough yielding assets. So there's $25 trillion of cash on the balance sheet of the private sector. That's more than all marketable treasury debt. There's $220 trillion of private sector net worth. So when you think about the size of the global or the U.S. aggregate index at about 50 trillion, there's a reason credit spreads are as tight as they are. There's a wall of money that needs yield today. And when you think about the demographic trends and the increase in savers, this narrative that we're on the brink of not having enough wherewithal to finance our debt is far from reality.
Okay, but given that, where is this wall of money going at times when you've got bond yields rising, you've got stocks selling off, and you've got the dollar weakening?
Okay, so 70% of marketable treasury debt comes due in the next 5 years. Every point on the yield curve 5 years and in trades at negative carry to cash, to the overnight rate. So where's the outrage? Honestly, that's a picture of more money than there are investable assets today.
So this raises a question going forward. Is this a bet that can get carried over to duration? You said that this was something that you were avoiding. Is it basically that you see that as the riskiest period right now, the idea of that 30-year or 20-year treasury that isn't very predictable?
It's really a matter of valuation. So, actually, at the long end of the curve, when you've got the long bond at 5% and corporate bonds, high-quality corporate bonds at 6%, that's a really nice environment if you're a long-duration buyer like an insurance company or a pension fund. For us, you don't really get compensated for the implied volatility of being out the curve. So the sweet spot is to be in the front to the belly where you get almost all of that yield without all that implied volatility. For a 60-40 portfolio, for the 40 for your fixed income part, you use that optimized expression that I just described, and then you marry it with equities.
Russell, looking at the spread right now between the supposed risk-free asset and credit at the moment, it's really tight. We were talking about Michael Hartnett of Bank of America this morning about how tight Microsoft was trading to the government bond, to treasuries. And in some maturities, trading through it at the very front end of the curve. Typically, we'd say that was a lot of confidence about corporate America. That's why spreads are so tight. But this time around, people are saying it's the opposite. They're saying there's a lot of fear about treasuries and whether the US government is trading as a credit. You push back a little bit against that. Could you explain that a little bit more about what people are getting so wrong?
Yep, so I think the risk-free curve is in equilibrium. It's twist-steepened since the election. I don't have my terminal in front of me today, but we were 444 on election day. I'm guessing we're right about there now. Front end's lower, back end's higher. Curves evolved in a stagflationary outcome. That makes sense to me.
That's what you think this is, a stagflationary shock going through the yield curve?
Yeah, a modest one, and that's what's reflected since election day. But as it pertains to spreads, so yeah, credit spreads are tight. I get asked that in every client meeting I go into today, but there's three reasons. One, credit quality is pristine across investment grade and certainly in the higher part of the high yield market. Second, people don't buy spreads, they buy all-in yields. And third, think about the technicals. There's some amazing statistics. So 20 years ago, the investment grade index and the treasury index were the same market cap. Today, the investment grade index is about half the size because the treasury market is growing more quickly. And the high yield market, 1.4 trillion in total market cap. The treasury market grows by that size every 9 months. So there's a relative scarcity of these credit assets today, and that's why spreads are tight and will probably remain so.
Do you expect spreads to tighten even more as companies refrain from issuing more debt at a time when yields are this high, given the fact that there is uncertainty and some of the CapEx plans might be put on hold, or M&A and other things that would require them to raise money?
Yeah, we've seen a pretty normal issuance patterns so far this year, and you definitely see a pullback when rates back up, and then they sort of reaccelerate when rates drop. So I see very normal behavior from issuers today.
You said something before that I thought was really interesting, that if you wanted to buy long duration bonds, you'd barbell it with stocks. You'd have this sort of barbell approach at a time when both are considered risky for different reasons. Are you believing that in some sort of downturn, that U.S. Treasuries will ultimately, to John's point, have the same function that they always have in terms of rallying and providing that ballast?
Absolutely, 100%. I mean, when you think about perhaps at this moment, I think the worry is around deficits, which are clearly on an unsustainable path. What is the next move if there were a shock, heaven forbid, another pandemic, where you needed a multi-trillion-dollar fiscal package? The good news is, in this instance, there's hundreds of basis points for the Fed to cut, and they could restart QE if they needed to. So there's lots of ammunition, and the front end of the curve would absolutely, respond to that easing of policy. And again, if you own your duration in the front of the belly, the curve's going to steepen, and that's going to work for you.
Final question. The point of asset scarcity, which runs right the way through this conversation, does China and Germany have something to say about that? Or Japan and Germany, rather, have something to say about that?
Well, I think this notion of U.S. exceptionalism being over is a narrative. I don't buy it. I mean, I think if you want real equity returns, look at the S&P 500 has an average return on equity of about 18%. Even the equal-weighted S&P, about 12%. So even for the equal-weighted S&P, you can double your book value over 6 years. The returns are exceptional.
That's the equity story, but you were talking about the bond market with regards to asset scarcity, supporting fixed income. And what we see taking place in Japan might upend some of that. Taking place in Germany in years to come might upend some of that. How does that factor in to your thesis?
So I think, the ubiquity of U.S. Debt and the size and depth and liquidity of U.S. markets are really unparalleled. There is no substitute. So the U.S. municipal bond market, in terms of its capitalization, is bigger than the German Bund market. I mean, there's just not really a whole lot of alternative.
Russell, this was great. I could talk to you all day about this. Rick is banned from this show from now on.
No way.
Just want to speak to Russell Brownback at BlackRock.
No way.
Are you trying to create dissent back in the ranks at BlackRock?
Rick's never banned. Don't worry.
I learned everything I know from Rick.
He's the best. I love Rick too. He just doesn't wake up early enough to come on this program anymore.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.